Welcome in, guys. Excited you guys to tune into the masterclass today. So if you're watching on Instagram right now, you guys, I'm going to kind of tease this a little bit, walk you through the kind of beginning of this presentation. But if you want to watch the full live one, there is a link. You just got to go to my story and you can actually get into this live call, this live masterclass through that link. So go to my story, click that link, and then you can interact. But in the meantime, I want to give you guys enough to kind of tease this up. So this masterclass today is going to be on strategies and investing in multiple ways to invest in real estate, from fixing and flipping to turnkey buying to being a passive investor, which might be debt or that could be equity. But I want to give people kind of the top three, I'll call my top three categories of ways you can invest in real estate and kind of give you guys some options. So at least you know what's out there. And I'm going to dive deep into what's unique to each one and what avatar is for one and which one might be best for you guys. So my background, a lot of you guys, if you're following me, probably know me at this point. But as I talk about this today, as you're seeing, if you guys are seeing my presentation, I've got all our different companies and brands that we have established and grown over the years, from our buy and hold company that manages our rental properties, Gregersen Properties, to our direct to seller acquisition company that helps us find all of our deals, which is YO Houses. And the last one we kind of most recently built out is Revive, which is our construction crew. And that allows us to kind of now tie in all three integrated companies to where we can do, because I'm going to talk a lot about fixing and flipping and again, turnkey and doing all this different stuff. When we have all this under one roof, it makes it a lot easier for us to do it all, right? But today I'm going to be focused on, hey, which one is best for you? I also talked about on this slide that we're looking at right now is just my background, right? I had a great W-2 income that helped me build my portfolio. But this presentation and I'm really wanting to talk to people who are doing well in their W-2 job, or maybe they're also just have their own business or have money to invest, or maybe they have good credit, and they can go invest. There's a lot of different ways you can do this, but ultimately I'm talking to you guys because I sat in your shoes. And I also realize there's not a lot of people that have had the time that I had or had a job that gave them the flexibility that I have, to where they could go spend all that time in real estate. So I want to give you guys several options. So when I kind of talk about the degrees of, I'm going to slide this over just a little bit. So with all of these different, these different ways, from fix and flip to turnkey to private money lending, there's different levels of from active to passive in your involvement, right? So if we're talking about, I'm going to slide this back over. So if we're talking about, the level of involvement in fixing and flipping, you are incredibly involved. That's the most involved you can ever be. And you got to be prepared to spend a lot of time, right? But then as we work back down the kind of involvement ladder, you get down to in the middle is what I call our turnkey investing. Those people can be a little bit involved, but there's also some things and processes and support and resources you can use to where you don't have to be completely involved like a fix and flip. And then as we work all the way down, we have private money lending, to where you don't have to have any level of involvement as far as of the operations. I mean, you can, depending on if you want to, but that's meant to be very passive, right? Then the next piece is risk. So how does this fall on the risk kind of or risk tolerance? So fixing and flipping, again, you're way at the top. That is the riskiest way, but also the biggest way to have the biggest gains in real estate, right? But that's going to be high risk, high reward. And actually, I'm going to talk about both these at the same time. You can see I've got risk and I've got reward and return. So again, fixing and flipping is the top of both. Think about turnkey investing. You're going to be right in the middle, right? Your risk is going to be much more mitigated because you're typically buying a buy and hold investment. And your reward, though, is going to be, you've got more upside because you're the actual owner. You can do the depreciation on the property. You're going to get the long-term cash flow. You're going to be able to make some decisions to really improve this asset of yours. So turnkey investing is kind of right in the middle of the risk-reward equation. You can impact it, but also you don't have to do it all by yourself. Again, kind of the happy medium. The last one is private money lending, right? We always talk about that. That's going to be typically the lower risk, but if you're a limited partner, you might be subjected to more risk and also more return. But in general, private money lending, you're going to take less risk, and you're also going to probably limit your upside. Again, depending on the structure, but typically that's the bottom of the spectrum. The last one I've been touching on a little bit is level of control. So if you're fixing and flipping and you're doing it yourself, you have all the control, right? You also have all the time commitments, but you control the deal, right? As you work down turnkey investing, you keep a little bit of control, but you also give up a little bit to a property manager and even maybe an aggregator, somebody who finds the deal for you. And then working all the way down to the private money lenders, their level of control is typically very little. Again, depends on how you structure it, but you don't have a ton of involvement, but also you don't have quite as much control. So those are kind of the three in those different spectrums. And I've got a really quick, good visual for you guys to see that if you're watching on Instagram. But the last one is, and then I'm going to kind of sign off at Instagram and encourage you guys to go watch the live masterclass. But I want to talk about the avatars, right? I want to talk about which avatar is best for each investment. So if we're looking at fixing and flipping, typically this is great for if you have a contracting background, or maybe you are a contractor. If you're not already fixing and flipping, this is a great one for you because you have that experience and you're going to have that knowledge. And that I'm going to talk later. Contractors and construction is the biggest risk when it comes to real estate in general, but especially fixing and flipping. This is great for full-time real estate investors and also good for somebody who really wants to hustle. As you guys, there's a lot of people out there, weekend warriors, people who want to go fix up something and flip it. So great way to do that. And they're a good avatar for that. The suggested amount of liquidity or capital you should be ready to invest if you're doing a flip, I'd say at least 100,000, if not more. I mean, it depends on the area, obviously, but you need to have a lot of capital because this is, again, the most riskiest one. And a lot of people get burned because they don't have enough capital when you have cost overruns, you have issues getting refinances. A lot can go wrong on that side of it. So being extra liquid is super important. The last one is, I want to give you guys some tips though. So typically, and I talked about this, I touched on it, but what I would advise people, if they have experience in any sort of trade, maybe it's in lending, especially if it's in construction, but if you have experience in the trades, that can really be great for you to kind of get started if you're wanting to go the fix and flip route. Okay. So now let's talk about the avatar for a turnkey buyer. This is great for high W-2 earners, great for business owners, and also good for new investors. And I'm going to get in, guys, I should have started here, but I'm going to dive into each one of these and really go deep. And honestly, I'm probably going to put together like full presentations for each one of these down the road. But again, today I'm giving you a high level overview of each one. And right now is the quick summary so you guys can hear it. But tune in to go deeper into each one of these for the second half of this. So the suggested liquidity for a turnkey investor, or how much you should be prepared to invest, is typically, I'd say, around $50,000, a minimum of $50,000. Obviously, it can go a lot higher, but with $50,000, at least in our market, you could get in, buy and hold property for $50,000. I mean, there's a lot of markets you can't do that for $50K, but be prepared to do that much. And then tips. So what makes another tip for a turnkey buyer is having strong credit. So if you have a great credit score and are have taken care of your credit, and also have good financials, turnkey buying is great because the small banks or whatever bank you're working with is going to love you and they're going to give you great terms, and you can really leverage your credit and use leverage to ultimately grow your wealth. Okay, the third and final one is talking about private money investors and that avatar. So these are people who have access to capital, right? They're also can be high W-2 earners. Like there's a lot of crossover between turnkey and private money lenders. That can be the same avatar. I would say, yeah, I mean, it really just depends. A lot of that is interchangeable. These also could be people who have assets. So typically this could be real estate assets that you can you could borrow against. This could be the stock market. This could be your 401k, your self-directed. All these are great vehicles or great assets that you can use to go and be a private money lender with, or be a limited partner. And again, that is a full presentation I really want to get into deeper and talk more about, but that's just touching on it. The amount of money or the suggested liquidity or a minimum amount. Man, private money could be any sum of money. I've seen people invest with $10,000. I've seen also a lot of people who raise money won't do anything less than 100K, but it could be any amount. And obviously there's no limit. And then kind of my tip here is this is really good for people who are tired of the stock market volatility or whatever they've been investing in. They're tired of the up and downs. When you invest in real estate as a private money lender, you typically get relief from that volatility. And as we know, real estate over time tends to be a little bit, I mean, it can be volatile here and there, but if you're a buy and hold investor, it's much less volatile than the stock market. Okay, so we're going to dive into all three of these right now. So I'm going to log off from Instagram. But guys, I encourage you, go to my story once again and go click the link and you can go watch this presentation and also be looking out for the recording later. I want you guys to go watch this. I want you to dig in deeper and look for more of this stuff to come. I want to dive deeper into subjects like this. So fix and flips. I've got a lot on this slide. I'm going to kind of summarize this and do this a much deeper dive later. But if you're thinking about fixing and flipping, I want to highlight kind of what to watch out for, right? So it's really important on the front end that you buy a good deal, right? So they always say you make your money on the front end. So buying a good deal is paramount. We ensure this because we go direct to seller. We negotiate all of our own contracts, and there's that just helps us because we see a lot of deals and we know what's a good deal and what's not a good deal. But if you're fixing and flipping, you might want to either work with a wholesaler or do some direct to seller marketing yourself, because you want to make sure that you can make some good margin on the front end, even before there's plenty of margin on the deal before you get started. A big part, I've talked about this already, is managing contractors. If you do not correctly do this, this is probably the fastest, undoubtedly the fastest way to lose in real estate and get started and crash and burn before you can ever really get going is not properly managing contractors. So I definitely advise people, if they're fixing and flipping and they don't have a contracting background, this is when I would partner up with somebody, or maybe set up a contract with your contractor to where they get a piece of the equity or a piece of the project at the end, because you want to align with them. If you don't align properly with a contractor, a lot can go wrong. Another big part of fixing and flipping is not having enough liquidity, something I mentioned earlier. If you go into a project and have cost overruns, a lot can happen. A lot can go wrong on a flip, and you could make it out and you could survive a lot of that, but you got to have enough liquidity. Seasonality, that's one that you don't really realize until you get into it, that you really, and we've really refined this over the years. For example, right now, I'm really trying to get a lot of flips going but I'm starting to outrun that window, because what I don't want to do is take on a flip in June that's going to take me 2 months and I'm going to list that thing at the end of August, because the market's going to slow down, right? But doing flips at the front end of the year to where you're listing in the spring and early summer, that's the timing you want to make sure you're hitting when you're flipping, because the market's always changing. You got to pay attention to corrections in the market. That's, again, when we talk about flipping risk, you're at the mercy of the market. And if the market dips like it did a year or two ago with interest rates, if you were investing in Boise or Las Vegas and they were at the peak of it and interest rates skyrocketed and all prices corrected sharply and you were flipping a house, you were in a bad spot. So you got to be careful with market volatility. Again, just the other thing is if you're dealing with permits and dealing with like municipalities, that can be another great risk. I didn't even say this yet, but if all these lessons, all these things to watch out for are pretty much lessons I've learned all the hard way, specifically even that one, dealing with permits, that can cause your budget to go way over. It can cause your timeline to go way over if you don't have that dialed in. So understand the process and how long it takes to get through permits. The other piece, you just got to pay attention to your holding costs. A lot of people just run their numbers. They say, hey, here's what I'm buying it for. This is what I'm going to rehab. This is what I'm going to pay my agent 5% in closing costs. And then that's how they run their numbers. They don't pay attention. Hey, what is my holding costs? What are my utilities? What is my insurance, taxes? And if you're using a lender, you got to factor in your lending costs. And what happens if this thing takes 3 instead of 6 months? All things you got to think about. Before we move on from flipping, my $1 million tip that will save you guys a ton. This is the best way to mitigate risk when it comes to fixing and flipping. And again, ask me how I know. I lived it, right? So when you go to fix a house and flip a house, always make sure you have 2 exit strategies. So my 2 exit strategies are, the first one here primarily is you want to fix and flip it. You want to sell this thing and make your quick cash, right? But what if that doesn't go according to plan? Well, can you hold this? My great second best option is, can I hold this as a rental? Will this property cash flow after I go, could I go refinance it? Or can I a lot of times I'll put on permanent debt on the front end, or fixed debt or something longer term debt, where you can get into trouble is using hard money, and then you get into a property that you can't sell and now you can't rent it out. That's when you're all you could do at that point is drop your price. So very important, you have 2 exit strategies anytime you're trying to fix and flip. Again, that could be keeping it as a rental, a long-term rental, could be a short-term. A lot of these markets now, as long as you have some experience or feel comfortable renting it out as a short-term rental, that can be a good way to mitigate risk, especially at a higher price point market. Just want to show you guys some numbers on flips. Got several of them here. This was one we did in Sheridan. Purchase price was $250,000. We rehabbed it for $63,000. Our holding costs were around $9,000. Sale price for $360,000. So before we get to the profit, this thing took us 6 months. So in our eyes, this was not a very successful flip because it took us a long time, and making $24,000 and spending 6 months on it, that's not the best ROI on our time. So, but again, this was actually one of the first projects we did with our new crew. So the fact that we actually turned a profit was still a win. This next case study is actually the same crew, and I believe it was our second or third job. Now you can see on this one, only took us 3 months. And now look at the profit. We made $41,000 on this one. So when it comes to fix and flipping, in addition to buying right on the front end, you got to make sure you keep your timelines low. That can make a big difference. And also when it comes to turning your money, and maybe you're raising money or working with a private money lender, if you could turn their money multiple times, you can raise more money, you can get more competitive financing. The timeline is super critical. So that's case study 2. Case study 3 is another one. This one we did in Cody, Wyoming. This was a much larger fix and flip. So again, I would not recommend it to somebody for their first fix and flip. Like these last couple where my rehab was $30,000, that's a manageable one. That was pretty much cosmetic. We weren't doing foundation, doing roofs, doing decks, doing electrical. I mean, we did it all on this one. You can see we spent $160,000 on this rehab. But at the end of the day, we made almost 90 grand. We made 829. It took us 5 months. So it took us a little bit longer, but a successful flip nonetheless. Now let's segue into turnkey buying. So we talked about this earlier. This is you're kind of in the middle of the spectrum from fixing and flipping to completely passive as a limited partner or a private money lender. So I really like this kind of schematic I'm sharing here on this as far as the journey of a turnkey buyer, to kind of show you like what it looks like, right? So from first off, choosing your market. The beauty of turnkey is you can invest anywhere. If you find the right property manager and the right like group or person that you trust to find the deal for you, you can go into any market. And I didn't even mention that with fixing and flipping. Typically, you're going to want to be in the market close to the deal, right? Versus turnkey, you can kind of go anywhere. So let's figure out, say you assume you found your market. Now you're looking about, hey, you want to kind of line up your financing. You want to go talk to a small bank. I would recommend, if you're doing this, you talk to somebody in that market, figure out the banks that they're working with, because all banks are not created equal. The next one is you could go find a turnkey provider or a wholesaler. As I mentioned, you want to find somebody boots on the ground who knows the market, who can help you find the deal. I would not advise anyone to go try to find their own turnkey deal without consulting somebody who knows the market and knows what to look for, right? You might pay a little bit more. Sometimes you might even pay a wholesale fee or some sort of fee for this, but 100% think that this is the way to go on your first one. The next thing is you start looking at deals, right? You're starting to look at deals, and eventually you'll put something under contract. You go through inspections, go through the appraisal, and then you close. And here is the best part about turnkey investing is when you close, if you do it right, you buy the right deal, it could be cash flowing on day one. So let me explain how important that is. Typically, if I go find a house, I fix it up, I get it rented out, and I go through all the steps of the process, I might be going 3 to 6 months with no income. And yet, if I'm using financing, I'm still paying a monthly interest in utilities and insurance. So I lose money for 3, 6, 12, who knows how long the project is, but I might lose money for a year before I start to cash flow it, right? You, on the other hand, as a turnkey buyer, can go buy a deal that somebody like me or another aggregator has already done all that. They've already invested the money to find it, fix it up, find a tenant. Because if you find the right turnkey deal, it comes out already ready to go for you day one. It's already got a tenant and a lease in place. The house is fixed up to where the day you close, you got a lease on it, and you start collecting cash flow on day one. I've got a lot of other kind of big perks of turnkey investing here. I'm not going to go through each one of them, but there's a ton of benefits, and I think it fits a lot of people. And again, like I said, it's kind of the perfect middle ground if you don't want to be too active, but also want to have some control and have some upside. I think it's a great option for people. A couple of case studies that we've done. A couple of these are actually active deals that actually we're looking to sell turnkey because we've already got them and we already found them, fixed them up, and we're currently renting them. So I've got one here. This one in Jefferson. This is actually in Casper, Wyoming. You can kind of see I kind of went to the quick pro forma from like, what is it renting? And this will show you guys too, if you're trying to evaluate a deal. I'm happy to share if you want just a quick little analyzer, I'm happy to share that. Just send me a direct message and I'll share a sheet with you guys, or a Google sheet or a spreadsheet. We use a lot of Google Sheets, but anyway, the way that you could build this out is you're looking at your rent, and then now you're looking at your your expenses from, I kind of summarized them all to one. Like your expenses are typically your mortgage and interest, your taxes, your insurance, utilities, property management fees, capital expenditures, and typically your operating expenses. So I've got all that broken down. This deal, I've just simplified that into the total amount. And then these are actually some deals. Hold on, I'm going to take a little step back. So typically when you're buying a turnkey deal, you got to go get your own financing. What we're actually doing on some of our deals, because we do so many deals with creative finance, a lot of times we'll go sell a deal to somebody that's already got the loan in place because it's actually the original sellers, or so it might be subject to, I'm getting too much in the weeds here, guys. This is a whole nother presentation on creative finance, but long story short, we have these deals here. We've already got the financing in place to where you walk in and you're walking in with these great interest rates. For example, I showed this in this column, like these are all 4 and 3% interest rates. And that's really when we get to the end and showing you the cash on cash return. That's why these deals cash flow so well versus probably all the deals you're looking at right now, because interest rates are 7, 8%. That's why these ones look way better. So I kind of calculated your cash on cash, which is simply if I put like on example 1 on Gregersen, if we put 50,000 down and then I just looked at what is our total cash flow or total basically profit after all expenses paid, divide that by the money we put in, and I do it annually. So that comes out to 19.8%. That's the one I highlighted at the very end. And then I just kind of shared the purchase price and the value and the equity. I would say this about Turnkey, right? Some of these deals I'm showing here, you're actually getting equity, meaning you're getting equity day one, you're buying the property at a discount. I would not always expect that as a turnkey buyer. I would more so be thinking, hey, am I getting a good cash on cash return? Do I have cash flow, right? That's typically enough. But also if you can get equity, meaning you're buying the property at a slightly below market value and you get cash flow, that's a home run, right? But typically if you're getting both, well, typically I would take one or the other. But again, if you're looking at turnkey, the more important one, I believe, is cash flow. You want to make sure you can, at the end of the day, you want to make sure if expenses went up or things change that you've got some margin. And then because what you don't want to do is buy a deal that's basically break even. You can do that. People do that all the time. I shouldn't say that you should never do that, but typically you're doing that if you're betting on appreciation, right? You're expecting this property is going to go way up in value and it's okay if you break even. But what we like to do is we like to buy stuff that cash flows from day one, and we've got some margin to where if taxes go up or insurance goes up, if you don't think that'll happen, just ask all the people here in Houston how they're feeling about all their taxes and insurance getting jacked up, and now all their deals, all their single family houses no longer cash flow. So that is a real thing, and you want to make sure you have some cushion. So I think that's good on the case studies, unless anybody has any questions. I did want to share a tip. So you can, and this is kind of what I talked about, right? Just to reframe this. If you really want to do turnkey the right way, work with a provider like we're doing here, where they are doing subject to or seller finance, because then you don't even have to find the financing. Because I'll tell you, working with banks and getting all that set up is a chore. And right now it's expensive just because of interest rates. So if you want to buy turnkey and have it really fully be turnkey, I would look for a provider that actually does seller finance turnkey stuff. So it's a little bit more complicated than I'm diving into right now, but once you kind of understand it, it's a really powerful way to buy turnkey. Okay. Now let's get into private money lending, right? So here's a bunch of benefits, a lot of flexibility. We've talked about a lot of these. I really want to kind of dive into some of the specifics and the different types of private money, because there's really kind of two ways you can go down. You can go down the equity route as like more of a partner or an LP, and you can go down the debt route where you're a lender, right? And your return is fixed. Okay. Let me show you that on this next slide. So I kind of show them both. When you're lending, right, you can be secured multiple different ways. Well, you could be unsecured, meaning that your investment or the money that you lend is not backed by an asset, right? It's not backed by the property. You could also be first position. That means that there's no other loans, it just means that you're in first position loan. Typically, when anybody's ever bought a house, you go to a mortgage company or the bank, they give you a first position loan, right? But if you've ever done a HELOC, sometimes they'll do a second position loan behind that if you have a lot of equity. When you're a private money lender, you could do the same thing. You could be in first position, lending on to where you're actually funding the entire deal or a good portion of the front end of the deal. Or sometimes I've worked with a ton of private money lenders, and I know a lot of other people do this, where you have a bank loan, or maybe it's a sub-2 loan, or who knows. There's a loan in first position, and then you can have the private money lender right behind them in second position. So if you're doing that, this is one of the things I wanted to talk about. Let me make sure it's not on this slide. Yeah. Hold on. I'm gonna move into that in a second, but there's some things to be careful about when you're in second position. Talking about limited partners though. So now limited partners, we're going back to the equity side of being a private money investor. So the typical structure is or a lot of people that are in private equity have heard of this, or maybe syndications. You guys have seen this, but this is your typical GP LP structure. So the general partner is a GP. So typically in my fund, I'm the general partner. I'm the one that finds the deal, puts it all together, right? But I bring in limited partners who come in who are very passive, and they bring capital. And then we define the return for them, but they actually get ownership. One of the biggest parts of being a limited partner is you get depreciation. Well, there's two things. You get the depreciation, meaning you actually get the same write-offs. Not the exact same again. It's very dependent upon your specific tax strategy. So talk to your CPA. But the beauty of being a limited partner is you're going to actually get exposure to some of the depreciation of real estate. And I'll tell you guys, if you didn't already know this, there are some people that purely invest in real estate just because of the write-offs they get. They don't even care about the cash flow or the appreciation. They need to have a tax shelter. And when you're a limited partner, you get exposure to that. The other thing is, I've talked about preferred returns and waterfalls. I think that's a little bit deep for this conversation today, but I do have a little schematic that I'm sharing right now that kind of shows you how we set up on one of our funds, how we set up the preferred return and the waterfall. But essentially, it's just an agreement on the profit share. And as far as the cash flow of the property and as far as when the property is sold, how are the profits all going to be split? So that's always defined on the front end. And then you can also do a simple 50-50 partnership, right? There's a ton of deals. I've done these. I feel like a lot of investors is how they get started is they find a partner, a 50-50 partner that brings the capital, and then they bring the deal and they operate it. And that's a great way to be passive, right? You could just bring the money, just make sure you got a trusted operator and somebody you believe in and you know well and you've vetted. But that can be a great partnership to where you could be completely passive and potentially get, whatever you negotiate, you might get 80% of the deal. Who knows? It's all up to however you structure it. So the private money lender, I want to talk about some risk mitigation. Again, I'm just going to touch on this, guys, today. I'm going to be talking to more people on my podcast and also doing other master classes on this to dive deeper, because this is a really important subject and a lot of people don't understand this, and it's important to know it if you're going to be a private money lender. So I talked about the first and second position, right? So the way that you're secured and the way that actually mechanically or logically happens on paper is through a promissory note and a mortgage. So think about your promissory note. That is just going to be the terms of your agreement. It's literally a note, a promise to you that I'm going to pay you this much money, and it outlines all the terms when everything's paid back. It's typically, I try to keep mine to be a page long. If you're at a bank, going through a bank, it's probably going to be longer, but it's typically pretty brief, goes over the terms, right? So that's the promissory note. The second document is a mortgage. This is what really protects you at the end of the day. This is what's filed at the county typically. So the borrower. So if I'm working with a private money lender, I will sign a mortgage. And then when I'm done, I will record that, or the title company will record that at the county. And that prevents me from ever selling this property or refinancing or doing anything on it without them knowing that, hey, I have a loan on it, right? It's documented and it protects the lender. Even if something were to happen to me, heaven forbid, then the lender's still protected, right? Or if I disappear, they're still secured. So very important that you take care of the mortgage. And I would definitely recommend you go through a title company to do this. The other thing is having a lender's insurance policy, right? So first off, if you're lending on a property, you want to be listed just like the bank does. You want to be listed on the insurance policy. If that house burns down, you want to make sure you're protected and your money, your asset and everything is still protected. So being added on the lender's policy is super easy, and you should definitely make sure you do that on every single deal. Yeah, and then the other piece is you just got to underwrite and know the operator, right? So underwriting the deal is very, very important, and I can share plenty of resources with you guys on how to underwrite the deal. But to put it in simple terms, a really safe way to do it is to figure out what is the property worth, and then how much are they buying it for, plus, or basically what's the total debt on the property, right? So easy numbers. Let's say they bought it for $50,000. They're going to put $20,000 of renovations in, so that's $70,000. Let's say they want to borrow a full $70,000. Well, if I see that house is worth $100,000, then if I divide 70 divided by 100, easy math, that's 70%. So you're at 70% loan to value. That's typically good cushion, right? Obviously, you'd love to be 60 or 50%, but also I've been in the shoes of the investor. We don't want to put 50% down. We want to be able to scale and do more deals. But also scaling me borrowing 100% of the value, which some people do, that can be risky for the private money lender, because if something happens or the market shifts, this deal could be underwater, and you might have to take back that deal, and you don't want to have to take back a deal that has no value in it, right? But on the flip side, if you're lending on a deal at 70% of the value, let's say that your borrower defaults. If you guys, a lot of people don't know this, but I've experienced it. There are a ton of lenders out there that they build their businesses based on people defaulting, because they take the property back. Now they got 30% equity on a deal that they didn't do any work for, but they underwrote and understood and made sure that it was a good deal. Like if you end up defaulting or giving that deal back to your lender, they're actually typically in a good spot, because they can go sell that. there definitely is some risk that you're halfway through the project, or not even halfway. You've drawn that same deal where you paid 50, you spent all the 20,000, or your contractor ran off with it and no work's been done, and this house isn't worth 100,000 because it's not fixed up. There's definitely some exposure there. So people control that with like the draw process, and there's a lot that goes into that. But at the end of the day, you as a private money lender want to understand what is the property worth and how much money is being borrowed. And if you're under 70%, that's an easy rule of thumb that's typically a good deal. Okay, any questions on private money lending and kind of the ways to mitigate risk? Well, shoot me a comment too, guys, if you're interested in diving deeper in this. It'll help me kind of, as we put together our podcast and some of our other future masterclasses, which ones you guys are most interested in. Let me show you a couple case studies and then we'll kind of wrap up. So private money lending. Here's a deal where a private money lender invested $96,000. He got, this was actually defined on the front end. So I put ROI, but it's really just an annualized interest rate. And we paid 12%. It's a deal we did actually with a private money lender in Sheridan, Wyoming. So they made almost $3,000 in 3 months, right? But that equated to a 12% return. Here's a couple of ones. These are ones I said in our current pipeline that we're currently working with private money lenders. You can kind of see, again, you can kind of see the numbers here, right? The investment amount, the amount of money that the lender's scheduled to make, the duration. And here, look at the LTV. That's what I was talking about earlier that I kind of went at length with, or talked at length about, is making sure your loan to value, again, what the total debt divided by the total value, making sure that's under 70%, right? This one was 73. This one was 50. So that one is really low. And this one was 69. So all these are pretty well risk adjusted. And if you were a private money lender on these ones, or I'll just tell you from my experience, when I talk to my private money lenders, this makes them feel really good, right? This one is a little higher, but I'm still under 75%. This one at 50%, they're like, yeah, this is easy. If I take this thing back, I'm sitting really good. And then this one is 69. So typically when you're working with a private money lender, if you're under 70%, they feel really good. Here's one last case study I want to show you. And this is a cool one where we combine private money lending and a partnership. So this is, if you guys haven't seen this one, this is my 63 unit apartment and growing. We're actually buying more of the units in Casper, Wyoming. So the way we structured this was we used debt. So basically we worked with some private money lenders that wanted, because I was really clear with them on the strategy. The strategy here is the BRRR. We're using, if you haven't heard of the BRRR, the buy it, rehab it, refinance it. Or sorry, first you're going to rent it, and then you're going to refinance it, and then you're going to repeat the whole thing because you get all your money back. So on this deal, because we bought it at such a discount and we're creating so much value, when we go to refinance, I'll be able to pull out my equity. And at that point, I'm going to be able to pay back some of these private money lenders, which we structured this as like 18 months. So anyway, we were able to give those guys a cool opportunity to get in and get a good interest rate and invest in a larger deal, but be completely passive. And then I partnered that with my equity partner. So I told him, I was like, hey, do you care if I raise some of my equity through debt? And he didn't have an issue and helped us to do a kind of a cool kind of like 50-50 partnership to where we both put in capital, and yeah, we'll both be able to project or take advantage of this deal. So we're planning to do this in we put 18 months. We're hoping that we're closer to 12. It'll probably be between 12 to 18 months when we can go refinance this thing, pull out all the capital, and then we'll have this big asset that we've gotten all of our capital back, and we continue to keep the asset over time, continue to have the cash flow, get the appreciation, the write-offs, everything you want, right? So this is a cool deal where you combine, again, people putting in debt at a fixed rate. Like I said, I didn't even touch on this yet, but they got a fixed 12%, and then a partner who's getting, obviously his return is much higher, but also he's taking a lot more risk. Oh, that's the last thing I want to share on this. And again, I'm going to be putting together a cool case study on this, but to show you how we did this, these units have actually already appraised for $90,000 to show you what we got in for it. And this is to show you like how the BRRRR strategy does work. And I will say this, guys, the BRRRR strategy, everybody looks for that. And it seems like it's one of the best ways to invest in real estate, but it is not easy. You have to find a great deal. You have to have great contractors, great property management, the whole gamut to really execute this. But to show you how we actually put it together, these units individually are already a couple appraised for $90,000. And our basis, or the amount of cost we've got into each unit, is around 60 to 65. So if you multiply that out by 72 units for this full building, that's like roughly $1.8 to $2.16 million in equity. Again, that was by us buying right, fixing it up, and creating a ton of value. And essentially, that's what's going to allow us to go refinance And because that 1.8 to 2.16 million of value, that's going to be our equity that the bank looks at when we go to refinance. It allows us to pull out our cash. All right. So that's kind of wrap it up, guys. If you are interested, I definitely encourage you to go follow our YouTube channel. You'll be able to see other videos just like this. Please do like and subscribe so you can see more of our videos. And if you enjoy it, that definitely helps us. I always talk to whenever I'm on a call with a new investor or networking with somebody, I always encourage them to, hey, go check out our stuff. If you like it, share it, because I just ultimately I want more people to see it and just have more of a bigger impact on people. So this is our YouTube channel. I've also got this QR code. If you go scan that, you can actually, here, I'll go to this next slide. And then here's my Instagram as well. But what I want you guys to do is, if you want to dive deeper, if you really enjoyed one of these parts or really want to be like, hey, Casey, I want to figure out I love Turnkey, but how do I get started? Like, what market should I look at? Or maybe you're like, hey, I want to be a private money lender. Tell me more about the mortgages and the promissory notes, or how do I find the right dealer or right operator, right? Or maybe you're a fix and flipper and like, hey, I'm ready to go find my next deal. Whatever it is, I would love to talk to you guys. So here's a QR code. You can go, and you'll also put this in the show notes, but go book a call. I'd love to dive deeper and see how I can help you guys. Any way I can. I really do enjoy that. That's why I spend the time doing these. Is a lot of people have helped me, and I definitely enjoy returning the favor. And it's always fun. It's always fun working with people. A lot of these people turn into our private money lenders, or they turn into our turnkey buyers, or like the case with that 63 unit, they turn into a partner that is also going to create long-term wealth, just like I'm being able to do for my family. So with that, I'll turn it over to questions, and we'll start to wrap up. Sweet. Well, I know I'm also working with this new recording app, and sometimes it has difficulty with people getting added to the room. So anyway, yeah, I'll probably wrap it up there, guys, and feel free. Like I said, you've got a link to my QR code. Just go book a meeting, or if you're watching this on YouTube or wherever you're watching it, feel free to make comments below. Definitely enjoy the engagement and be happy to ask questions that way. Or like I always say in all of my content, send me a direct message. I'll answer your questions. And stay tuned for more. I'm really excited to dive deeper into these 3 subjects that I talked about today, from fixing and flipping to turnkey buying to private money lending or investing. And I want to dive deeper on those subjects and just show you guys more and more. So let me know. Also leave me a comment if you guys specifically, is there anything you want to hear about more and dive deeper, and kind of where you guys want to see that. So I'm excited I really need the feedback, guys. I want to know, hey, I want to hear more about this or that. And that way we can prioritize the videos we put together. So with that, I'll tune out and look forward to talking to you guys. Please reach out.